Okay, let's unpack this. We're diving into a document today that honestly looks like pure jargon. It's a special tax notice about retirement payments.
Yeah, the kind of thing you might get from, say, the Galveston Firefighters Pension Fund, like in our source material.
Exactly. But hidden inside this, well, this bureaucratic notice is basically the key to avoiding a huge mistake lots of people make when they leave a job or retire.
It really is. We're talking about the difference between keeping all your retirement money growing tax deferred versus losing like 20% of it immediately to federal withholding. It's essential stuff if you have a qualified plan, a 401k, 403b, maybe a governmental 457b, and you're about to get a payment.
So our mission today is to cut through that dense language. We want to pinpoint the main choice you face with what they call an eligible rollover distribution.
And really highlight that 20% tax trap that catches so many people totally unaware.
Right. The big question is, how do you get your hands on your retirement money or move it without triggering immediate taxes?
And the answer comes down entirely to that first instruction you give the plan administrator. Which brings us neatly to the two main paths you can take.
Okay, path one.
Sure.
And spoiler alert, this is generally the one you want to aim for, the direct rollover.
Simple concept. The money goes straight from your old plan administrator to your new retirement account.
Which could be a traditional IRA or maybe another eligible employer plan like your new job's 401k.
And the beauty of the direct rollover is what it avoids.
Which is?
Mandatory withholding. That 20% chunk we mentioned, it doesn't happen. The money just flows tax-deferred from point A to point B.
Clean. Simple. Tax isn't due until way down the road when you actually retire and take the money out of that new account.
Precisely. Now, path two. This is where things get tricky.
This is the pay-to-you option. You tell the administrator, just send the check to me.
And here's the kicker, the rule that surprises everyone. If you do that, the plan administrator is required by law to withhold 20% of the taxable amount.
20%.
Yep. They cut 20% off the top and send it straight to the IRS as federal income tax withholding.
So let's make that concrete. Say you're due a $10,000 taxable distribution. You choose paid to you.
You open the envelope or check your bank account, and you only see $8,000.
Wow. That other
Yes.
$2,000 is just gone. Sent to the IRS.
Instantly. Doesn't matter if you fully intend to roll that money over into an IRA the very next day. The 20% is withheld up front if it touches your hands first.
Yeah, it feels punitive. Especially if you do plan to roll it over. Why did they do that?
Well, the thinking from the IRS side is sort of like a deposit, you know? They want to make sure they get some tax money up front, just in case you end up spending that distribution instead of rolling it over. It's insurance for them.
Okay, that makes a certain kind of sense, I guess. But it's a huge potential pitfall.
Absolutely.
Now, the notice does mention something about a waiting period, like 30 days.
Yeah, generally they have to give you this notice at least 30 days before they can actually make the payment or process the direct rollover.
Gives you time to think, I suppose.
Exactly, a time to weigh these options. But, and this is important, the source material says you can waive that 30-day period.
Oh.
Yeah, if you've made your decision, you can make an affirmative election, basically tell them, yep, I know the choices, do it now. This can speed things up, which might be important if you're trying to time the market or get funds moved quickly.
Okay, good to know. So let's say you choose the smart path, the direct rollover. Where can that money actually go? Let's talk about the eligible rollover landscape.
So the main destinations are a traditional IRA or another eligible employer plan.
And what falls under eligible employer plan?
That's things like another 401k, a defined benefit pension plan, profit-sharing plans, 403bs, and those governmental 457b plans. Pretty broad.
But here's a potential snag, right?
Yeah.
Just because a plan can accept a rollover doesn't mean it has to.
That is a massive heads up. Your new employer's 401k is not legally obligated to accept your rollover from your old plan.
Seriously. So you could do everything right on your end, request the direct rollover, and the new plan just says, nope, we don't take those.
It can happen. So step one, before you initiate anything, is you absolutely must check with the administrator of the plan you want to roll into.
Ask them point blank, do you accept rollovers? What paperwork do you need? Are there any weird restrictions after the money arrives?
Exactly. Things like spousal consent rules if you want to take money out later, or limits on subsequent distributions. You need to know that up front.
Got it. Now, what about places the money absolutely cannot go via rollover from these plans?
Yeah.
The definite no-fly zones?
The IRS is very clear on this. You cannot roll these funds into a Roth IRA.
Okay, no Roth.
No simple IRA either, and no Coverdell education savings accounts.
Right. try to send it there, and boom.
It's treated as a taxable distribution.
Yeah.
And if you're under 59 and a half, you're likely looking at that extra 10% penalty on top of the regular income tax. Ouch.
Okay, definitely avoid those.
Yeah, another layer of complexity. What if you have after-tax money in your plan? Money you contributed that you already paid income tax on.
Yes, after-tax contributions. These can be rolled over, but the rules get really specific.
Oh, so? Well, you can roll them into a traditional IRA or sometimes into another employer plan. But if you roll after-tax money into a traditional IRA,
Yeah.
it becomes your job, entirely your responsibility to keep track of that after-tax amount versus the pre-tax amount and any earnings.
For years. Decades, maybe.
Potentially, yes. You have to track the basis, that non-taxable portion, and report it correctly to the IRS every time you take a distribution from that IRA, maybe many years later.
That sounds like a record-keeping nightmare waiting to happen. What if you mess up the tracking?
If you can't prove the basis, the IRS will likely assume the whole distribution is taxable. So yeah, it's risky.
Is there a better way for after-tax money?
There's a huge warning here. Once after-tax money goes into a traditional IRA, it's stuck there in terms of rollovers. You cannot later roll that specific after-tax portion back into an employer plan.
Whoa, okay, so that's a one-way street.
Very much so. If you want to keep after-tax contributions within the employer plan system, you generally must do a direct rollover into a new employer plan.
And that new plan has to be willing and able to handle it, right?
Correct. The receiving plan must explicitly agree to accept the after-tax funds and have a system to separately account for them in their earnings. Oh, and one more thing. After-tax funds generally cannot be rolled into a governmental 457 plan.
Man, the details just keep coming.
Yeah.
Okay, let's shift gears slightly. Are there types of payments from these plans that you just can't roll over at all, the no-roll zone?
Yes, there's a list of distributions that are specifically ineligible for rollover treatment. These generally aren't considered funds meant for continued long-term deferral.
What's top of that list?
Payments that are spread out over long periods. If your distribution is part of a series of substantially equal payments,
Okay.
scheduled to last for your lifetime, or joint lives with the beneficiary, or for a fixed period of 10 years or more, that payment stream isn't eligible for rollover.
So like an annuity payout from the plan.
Kind of, yeah. Also, required minimum distributions, or RMDs.
Ah, the ones you have to take after a certain age.
Right. Once you hit that required beginning date, age 73 for most people now, or sometimes later if you're still working, unless you're a 5% owner, the RMD amount for that year must come out and be taxed. You can't roll it over.
Makes sense. What else is on the exclusion list?
Hardship distributions, those are definitely out.
Okay.
Dividends paid on employer stock held in an ESOP, an employee stock ownership plan, those usually can't be rolled over.
Got it.
And things called corrective distributions, these are usually made to fix some kind of operational error in the plan. They're not eligible either.
Okay, now let's clear up something that sounds confusing. Plan loans. The notice mentions two things that sound similar but are treated differently. A defaulted loan and a loan offset.
Yeah, this is classic jargon causing confusion. It's a really important distinction.
Lay it out for us.
If you simply stop paying a plan loan, you default. That outstanding loan balance is then treated as a deemed distribution.
Deemed distribution. Sounds bad.
It is. From a tax perspective, it's considered taxable income to you in the year of the default, and critically, that deemed distribution amount cannot be rolled over.
So you owe taxes, potentially penalties,
Yeah.
and you can't fix it with a rollover. Ouch.
Right. But a plan loan offset is different. This usually happens when you leave your job.
Okay.
The plan basically says, okay, you owe $5,000 on your loan and you have $50,000 in your account. We're taking $5,000 from your account balance to offset and pay off the loan.
Ah, so they use your own plan money to clear the debt.
Exactly. And that loan offset amount is considered an eligible rollover distribution.
Really? So even though the loan got paid off from the plan balance, I could still theoretically roll over that $5,000 amount.
Yes. You'd have 60 days to come up with $5,000 from other sources, savings, whatever, and roll that amount into an IRA or new plan to keep it tax deferred.
That's a huge difference between deemed and offset.
Okay. Huge difference. The offset gives you a chance to save the situation. The deemed distribution is usually just an immediate tax hit.
This all loops back to that critical moment. What if you did take the payment paid to you? You got the check for $8,000 instead of $10,000. Now what? This is the 60-day tightrope walk, right?
That's a good way to put it. You have exactly 60 days from the date you receive the distribution to get that money into a traditional IRA or another eligible employer plan.
But the big catch is that missing 20%.
The $2,000 in our example that went straight to the IRS, if you want to roll over the full $10,000 taxable amount to keep it all tax deferred,
I have to find that $2,000 somewhere else, out of my own pocket.
you absolutely have to. You need to deposit the $8,000 you received plus an additional $2,000 from your savings or another source into the rollover account within that 60-day window.
And if I only roll over the $8,000 I actually received,
Then the $2,000 that was withheld is treated as taxable income to you for that year. You'll owe regular income tax on it.
but if I do manage to roll over the full $10,000 by adding my own $2,000,
Then you've successfully deferred tax on the entire $10,000. And that $2,000 that was withheld, it now becomes essentially an overpayment of your taxes for the year.
so I'd get it back.
You'd claim it when you file your tax return, likely resulting in a larger refund or smaller tax bill. It works out, but it requires you having that extra cash available short term.
Okay, that 60-day deadline combined with the 20% makeup is a real pressure point.
It is. And if you don't roll it over or only roll over part of it, we have to talk about the other potential penalty.
The 10% additional tax, the early withdrawal penalty.
Right. If you receive a distribution and don't roll it over and you're under age 59 and a half, you generally owe that 10% penalty on top of the regular income tax on the taxable amount.
That adds up fast. 20% withholding up front, plus regular income tax, plus potentially another 10% penalty.
Yeah, it can be a very expensive mistake, but importantly, there are exceptions to that 10% penalty.
Good. What are some common ones people might encounter?
Probably the most widely used one involves separation from service. If you leave your job during or after the calendar year you turn age 55, distributions you take after separating are generally exempt from the 10% penalty.
Age 55 rule. Got it. What else?
Payments made because you become totally and permanently disabled, those are exempt.
Okay.
Payments made directly to the IRS to satisfy a federal tax levy, also exempt.
Right.
And payments made to an alternate payee, like an ex-spouse under a qualified domestic relations order or QDRO, they typically avoid the 10% penalty too.
That covers quite a few situations. And there was something specific about governmental 457 plans, wasn't there?
Yes, a special rule. Generally speaking, the 10% additional tax does not apply to distributions from a governmental 457B plan.
Oh, interesting. Flat exemption.
Mostly. The big catch is if the money in the 457 plan originally came from a rollover from a different type of plan, like a 401k or an IRA. In that case, the 10% penalty rules from the original source plan still apply to that rolled-in money if you take it out of the 457 plan before 59 and a half.
So the money remembers where it came from, basically.
In a way, yes. You can't just wash the penalty risk by rolling into a 457.
Okay, nearly there. We should quickly mention a couple of really niche advanced scenarios, just so people know they exist, like for folks born a long time ago or those with company stock.
Right, just a quick flag. For people born before January 1st, 1936, there might be special tax treatments available for lump sum distributions like 10-year averaging or capital gain treatment.
But it's complicated, right?
Very. Lots of restrictions. Usually a one-time election requires years of plan participation, and you generally lose this option if you roll the money into an IRA, 403B, or governmental 457. Needs expert advice.
And the company stock thing, NUA.
Net unrealized appreciation, NUA. This applies if your distribution includes employer stock. If certain conditions are met, like it being a lump sum distribution, the growth in the stock's value while it was inside the plan might not be taxed until you actually sell the stock, potentially years later, and maybe at lower capital gains rates.
That sounds like a big deal for people with lots of company stock.
It can be a huge tax benefit. But the key warning, if you roll that employer stock into an IRA, or usually even another employer plan, you typically lose that special NUA tax treatment forever.
Another get specific advice before you act situation.
Absolutely critical for NUA.
Okay, last piece. Who actually gets to use these rollover rules when it's not the employee themselves? Let's talk beneficiaries.
The rules are pretty good for surviving spouses. A surviving spouse basically steps into the employee's shoes.
Meaning?
They have the same rollover options, direct rollover or payment to them with the 60-day rule and withholding. They can roll it into their own IRA or sometimes an employer plan, and importantly, they're generally not subject to the 10% early withdrawal penalty.
What about an ex-spouse getting funds via a QDRO?
Same deal. An alternate pay under a QDRO generally has the same rollover rights and penalty exemptions as a surviving spouse.
Okay, but what if the beneficiary is, say, a child or a sibling, a non-spouse beneficiary?
That's completely different. A non-spouse beneficiary cannot do a rollover in the same way. They can't choose a direct rollover to their own IRA in the traditional sense, and they can't take the payment and then roll it over within 60 days.
So what can they do?
Their main option is typically a direct trustee-to-trustee transfer into a specially titled inherited IRA. Those have their own set of complex distribution rules, often requiring a full payout within 10 years now. It's outside the scope of these standard rollover rules we've discussed.
Got it. Inherited IRAs are a whole other deep dive.
Definitely.
Okay, so we've covered a lot of ground. Let's try to boil it down. What does this all mean for someone getting that notice?
It means that first decision is absolutely critical because the stakes are high, the complexity is real, but you have control at that initial step.
And the single most impactful choice.
Avoid the mandatory 20% federal withholding. The simplest, cleanest way to do that is to choose a direct rollover. Have the money sent straight from the old plan to the new IRA or plan.
And if for some reason you do choose paid to you,
Be prepared. Know that 20% will be missing, and if you want to keep the whole amount tax deferred, you must find that 20% from other funds and get the full amount into a rollover account within 60 days.
and the critical action item, underlined in the source document itself.
Talk to the administrator of the receiving plan before you do anything. Confirm they'll accept the money, understand their process, and know about any strings attached once the money lands there. Don't assume anything.
Right. Because acceptance isn't guaranteed, and the rules can vary.
Exactly.
Okay, that brings us to our final provocative thought. Everything we've talked about, all these complex rules.
They're only the federal tax rules.
The notice itself flags this right at the end. It explicitly says it doesn't cover state or local taxes.
So the question for you, the listener, is, once you've navigated the federal maze, what about your state? Or even your city? Do they have their own withholding rules, their own penalties, different rollover requirements?
Because those state and local rules could easily add another layer of cost or complexity right on top of everything we just discussed.
Something you definitely need to investigate for your specific situation before making that final decision.